Okay, Assalamualaikum and a very good morning. Hi everyone, I will explain about the last chapter of this FIN542, which cover the financing foreign trade. Okay, this is the chapter 9 out of all topics. So this chapter actually will discuss about the payment terms in international trade. So when it comes to the what we call international transaction, so we will involve with the payment of goods. So the buyer tends to prioritize the cheapest and most straightforward payment method. In other words, it's anything that can help reduce costs. Okay, another priority is ensuring that the buyer will receive the good specified. Okay, while the buyer prefer paying as late in the transaction process as possible, sellers will want to be paid in full as quickly as possible and via the secure option. Sellers who offer attractive payment terms and varying methods will have advantage over those who limit themselves. The main international payment methods used around the world today include cash in advance, letter of credit, open account, and consignment. So next, I will explain by each payment methods with their pros and cons. Okay, first of all, cash in advance. Okay, cash in advance, also known as prepayment. Okay, the buyer completes the payment and pay the seller in full before merchandise is delivered and shipped off the buyer. While there are plenty of cash in advance payment methods available, such as credit card, wire transfer, that is the most commonly used payment method. Okay, so while this is an attractive option for sellers, it is actually high risk for buyer because it will produce disadvantageous cash flow and no definite guarantee of receiving the goods or the conditions in which they arrive. So this is generally recommended option for sellers who are dealing with new buyer or buyers with weak credit rating and for the high value product. Other cash in advance method include debit card payment, telegraphic transfer, or international check. Okay, these are the pros and cons of cash in advance. As a buyer, this cash in advance has the minimal pros to the buyer, but the cons is they will have high risk of not receiving shipment or receiving damaged shipment, and buyer tend to have the high cash flow. Okay, so the cons may be the buyer will get unfavorable cash flow. So this cash in advance have pros to the seller because it will secure full payment before shipment and no risk of non-payment. But the cons of this method is the risk of losing business to competitors if offering this as the only accepted international payment method. Okay, the second one is letter of credit. What is letter of credit? Okay, this letter of credit is one of the most secure international payment methods for the importer and exporter, as it involves the assistance and established financial institutions such as bank as intermediary and a certain level of commitment from both parties. Okay, with a letter of credit, payment is made through both the buyer and seller's bank. Okay, in other words, they use bank as their middle parties. Okay, upon confirmation of trade terms and conditions, the buyer will instruct his bank to pay the agreed upon sum by both parties to the seller's bank. The buyer's bank then send a letter of credit as proof of sufficient and legit fund to the seller's bank. Payment is only remitted after all stated conditions are met by both parties and shipment has been shipped. So, letter of credit, also known as LC, banker's commercial credit, or documentary credit. This type of payment will have the pros. Okay, the pros of the letter of credit to the buyer is the buyer will guarantee of cargo being shipped before payment. Okay, obligation by seller to fulfill stated and negotiated condition. But the cons to the buyer is the reliance on seller to ship goods as specified. Okay, this type of payment has pros to the seller as a reliable proof of foreign buyer's credit prior to shipment of goods. Obligation by buyers to fulfill stated and negotiated condition. Payment by buyer's bank in the event of a default, and low risk. And this kind of payment has minimal cons to the seller. And then let's look at the next type of payment, which is open account. Okay, under open account, which is also known as account payable, merchandise are shipped and delivered prior to payment, proving to an extremely attractive option for buyers, especially in terms of cash flow. On the other hand of the spectrum, however, sellers are faced with high risk. Okay, with this payment option, the seller ship the goods to the buyer with a credit period attached, usually 30 days or 60 days or 90 days periods, during which the buyer must carry out full payment. And this kind of payment is usually only recommended for trustworthy and reputable buyers. For buyers and sellers who have an established and trusting relationship, or for export with relatively low value, or to minimize the risk. This kind of payment, the pros to the buyer is the buyer will tend to receive goods before payment is due and positive cash flow. And this has minimal cons to the buyer. To the seller, this kind of payment can attract customers in competitive market, but they will get high risk of default. Okay, and the last one, I think, consignment. Okay, consignment process is similar to that of an account, whereby payment is only completed after the receipts of merchandise by the buyer. So the difference lies in the point of payment. With consignment, okay, the foreign buyer is only obliged to fulfill payment after having sold the merchandise to the end customer. So this international payment method is based on the agreement under the foreign seller retains ownership of the merchandise until it has been sold. In exchange, the buyer is responsible for the management and sale of merchandise to the end customer. Okay. Also, consignment is only recommended for buyer and seller with a trusting relationship or reputable distribution and providers. Given the high risk involved, sellers should make sure they have adequate insurance coverage that can cover both the goods from the transit to the final sale and mitigate any damages caused in the event of non-payment by the buyer. Okay. So, for this kind of consignment, the buyer will get the goods and the buyer will pay the goods after they sell all this good. Okay. So the pros to the buyer, the payment is only due only after final sale of good to end consumer and need quick receipt of goods. But the buyer will have to manage the merchandise and may have a large inventory to manage. For the seller, lower storage fees. Seller will not have to keep the inventories, less inventory management, and more competitive. But this will be high risk for the seller of payment may not guaranteed until end sale, and lack of access to and management of merchandise. Okay, so in terms of the security, the least secure payment method to the exporter, to the seller, is consignment. Okay, followed by open account, documentary collection, letter of credit, and the most secure is cash in advance, because the seller will get full payment even though they not ship or send the goods to the buyer. For the importer, the least secure is cash in advance. Okay, because the buyer have to pay in full even they didn't get the goods yet. And followed by letter of credit, documentary collection, open account, and the most secure is consignment, because during with consignment, buyer only pay after they sell the goods. Okay, next we go to document in international trade. Okay, there are many supporting documents required in international trade in commercial bank. Okay, all these documents are issued by exporter or shipping line, airlines, international trucking companies, freight forwarders, logistic companies, custom bank, and insurance companies. Okay, let's look at the first one is bill of lading. Bill of lading, also known as BL or BOL, is a legal document issued by a carrier to a shipper that details the type, quantity, and destination of the goods being carried. BL also serves as a shipment receipt when the carrier delivers the good at a predetermined destination. This document must accompany the shipped product, no matter the form of transportation, cargo or air, sea cargo, and must be signed by authorized representative from the carrier, shipper, and receiver. Okay, the bill of lading is a legally binding document that provides the carrier and shipper with all of the necessary detail to accurately process a shipment. It has three main functions. The first one, it is a document of title to the goods described in the bill of lading. Secondly, it is a receipt for the shipped product. And finally, the bill of lading represents the agreed terms and conditions for the transportation of the goods. Okay. The second document is commercial invoice. Okay, one of the most important documents in international trade and ocean freight shipping. So, commercial invoice is a legal document issued by the seller, which is an exporter, to the buyer in an international transaction and serve as a contract and proof of sale between the buyer and seller. Okay, it is not similar to bill of lading. The commercial invoice does not indicate the ownership of goods, nor does it carry the title of the good being sold. It is, however, required for custom clearance purposes to calculate and assess the duties and tax due. So, in the commercial invoice, the detail is the price, value, quantity of the goods being sold. Okay, it should also the trade or sale condition agreed upon by both buyer and seller of the transaction being carried out. Okay, so it may also be required for payment purpose. such as in the event of payment via letter of credit and may need to be produced by the buyer to its bank to instruct the release of funds to the seller for payment. The third one is insurance certificate. Okay, this is a document used so that coverage is provided to cover loss or damage to cargo while in transit when insurance is placed against an open marine cargo policy. In some cases, a shipper may issue a document that certifies that a shipment has been insured under a given open policy, and the certificate represents and takes the place for such open policy. Because of the objection that the instrument of this kind did not constitute a policy with a requirement of letter of credit, it has become the practice to use an insurance certificate. It is also called cargo insurance certificate and special cargo policy. Next document is consular invoice. An invoice covering a shipment of goods certified by consul of the country for which the merchandise is destined. The invoice is used by custom official of the country to verify the value, quantity, and nature of the merchandise imported to determine the import duty. In addition, the export price may be examined in the light of the current market price in the exporter's country to ensure that dumping is not taking place. And last document is certificate of origin. Okay, it is describe the country of origin for the shipment. The certificate of origin may also known as declaration of origin. Usually the certificate issued by the Chamber of Commerce in the country of the exporter. In addition, the certificate of origin is usually needed by countries that are part of trading bloc. For example, where there is an organization of countries, for example, European Union or ASEAN, okay, that trade with each other. For example, for ASEAN, maybe Malaysia and Thailand, the trading, we have the agreement in ASEAN, maybe the import of some goods will have the free trade, free tax. Okay, no tax involved. Okay, a certificate of origin for a shipment is also a good way to see if the product are really authentic in terms of where they claim to be coming from. So this document required by the buyer in the documentary requirement stated within a letter of credit. The letter of credit may specify additional certificate or language within that must be noted in order for the certificate of origin to comply with the stated requirement. Okay, so next we move to the financing technique in international trade. Okay, the first one is banker's acceptance. How to pay, okay? How to pay the shipment, the goods. We use banker's acceptance or letter of credit. Okay, the banker's acceptance is an instrument representing a promised future payment by a bank. The payment is accepted and guaranteed by the bank as a time draft to be drawn on a deposit. The draft specifies the amount of fund, the date of payment or the maturity, and the entity to which the payment is owed. After acceptance, the draft becomes an unconditional liability of the bank. Bankers' acceptance are distinguished from ordinary time draft in that ownership is transferable prior to maturity, allowing them to be traded in the secondary market. Okay, a banker's acceptance starts with a deposit in the amount of the future payment plus fees. A time draft to be drawn on deposit is issued for the payment at a future date analogous to the post-date check. The bank accept, okay, ataupun the bank guarantee the payment to the holder of the draft analogous to the cashier's check. The draft holder may hold the acceptance until maturity and receive the face value payment from the bank, or it may sell or exchange the acceptance at a discount to another party willing to wait until maturity to receive the bank's promised payment. Okay, the second one is discounting. Discounting is the process of determining the present value of payment or a stream of payment that is to be received in the future. Given the time value of money, $1 is worth more today than it would be worth tomorrow. Discounting is the primary factor used in pricing a stream of tomorrow's cash flow. So in international trade, discounting is the action of selling the future cash flow the company will get today at discounted value to the bank in order to get advance payment. Okay, so I think that's all. We will look to the example. Okay, so this a situation, the example of situation of paying of the payment to the seller. Okay, so should the company hold the acceptance until maturity or sell the acceptance at once today? Okay, we look at Nico Shoe Company of Durham, North Carolina, okay, US. Nico Shoe in US has received an order for 100,000 carton of athlete shoes from Leicester Footwear of England. Okay, so the countries involved is US. This one is US and UK. Okay, so Nico Shoe is a seller and Leicester is a buyer. Which payment to be made in GBP? Okay, so Leicester will pay Nico Shoe in pound. The shoe will be shipped to Leicester Footwear under the terms of a letter of credit issued by a London bank on behalf of the company. Okay, so the letter of credit specifies that the face value of the shipment is £1 million will be paid 120 days after London Bank accept a draft drawn by Leicester Footwear in accordance with the terms of the letter of credit. Okay, Nico Shoe get an order, meaning that Leicester want to buy athlete shoes from the Nico Shoe. So Leicester will instruct the bank, London Bank, to issue letter of credit to the Nico Shoe. Okay, so the face value is £1 million. Okay, 1 million must be paid within 4 months. Alright, next, the current discount in London on 120 days banker's acceptance is 10% per annum. The commission fee for a banker's acceptance is 2.5% per annum. And the bank also charges 1.5% flat rate on the value if it's sold at discount. If Leicester Footwear is weighted average cost of capital or required return to be 15% per annum, determine the amount of cash Nico Shoe Company will receive if it hold the acceptance until maturity. So now Nico Shoe will get the letter of credit from the Leicester. Okay, £1 million, but the maturity is 4 months. So when Nico Shoe get the letter of credit, should Nico Shoe hold the letter of credit or the acceptance, or hold until maturity, hold until 4 months, or just sell today? Okay, so what is the amount that Nico Shoe will receive if it hold the acceptance until maturity, until 4 days. 4 days pula. 4 months. But and what is the amount if Nikoshu sell the letter of credit today? Okay, so let's look at together. Let's do it together. Okay, this is the information given. If, okay, we calculate if Nikoshu hold the letter of credit until maturity. So the face value is 1 million. If the company hold the credit until maturity, the company will pay the acceptance fee. Acceptance fees is 2.5, this one, commission fee, 2.5% per annum. Okay, so 1 million times 2.5% because of 120 days, so meaning that 4 months over 12. So if we calculate, you will get 8,333.33 cents. Okay, so face value will less the acceptance fees. So the amount received by the Nikoshu in GBP 991,166.67 if after 4 months. Okay, if the company hold the letter of credit until maturity. Okay, what if Nikoshu sell the letter of credit today? Okay, at once. The face value 1 million, we have to minus commission and acceptance fees. Similar to this calculation, 1 million times 2.5%. Because of per annum, we have to divide 4 over 12 because this one is only 4 months. So we'll get 823.23, and then this minus the discount rate, discount rate 10% per annum, again 10% times 4 over 12. It depends on the maturity period. If 90 days, meaning that 3 over 12. If 60 days, 2 over 12. Okay, and then after we calculate the discount rate, it is 33,033.3. And flat rate on face value, we also have flat rate. Bank also charges 1.5% flat rate on the value if it's sold at discount. Discount meaning sell credit at once. So 1 million times 1.5%, you will get 15,000. So after we minus all this, you will get 943,333.34. Okay. This option, hold the letter, this amount is after 4 months. And this value is now. Okay, we cannot compare because the different time. This value is after 4 months. This value is about today. Okay, because of this, we cannot compare whether this company have to wait until maturity or to sell now. Okay, if we just compare this, we just simply choose this option, hold until maturity. But it's not fair because this value is after 4 months and this value is for today. So you have to calculate the present value. This one is the value after 4 months. You have to calculate this value today. Okay, so then we need to decide whether Nikoshu company should. Okay, so you have to calculate the present value of future amount. So here, future amount received divided by 1 plus 0.15 divided by 3. Why we divide by 3? Because 4 months, 4 over 12, or you can just times 4 over 12 of similar divided by 3. Okay, so if we calculate here, the present value is 943,968.26. So now we can compare the value. Okay, 943,968.26 or this 943,333.34. So this value is today. After 4 months, we will get 993. You get what I mean? So because of the same time, we can just compare. So based on this, we can decide that this company should hold the letter of credit until maturity because the value that they will receive is higher compared to sell today. Okay, alright. If you do not understand, you just repeat this video several times until you understand. Okay, and for another exercise, okay, so this exercise is a little bit different because we have the exchange rate. You have to exchange the rate. Okay, FBI Berhad, which is a Malaysia-based company, has received an order from China. The export process in the other terms of letter of credit issued by ACBC Bank upon the Chinese buyer process. Okay, this what we call the country involved is Malaysia and China. So the China banks is ACBC Bank. So the payment will be made after 6 months after ACBC Bank accept bill of exchange drawn by FBI. The export is worth $5 million. The current discount rate is 7.5% per annum as the acceptance fees is 2% per annum. Okay, there is a commission fee 0.5 of the face value if the banker's acceptance is sold. At the time of acceptance, the exchange rate is 3.6290 and Malaysia ringgit is expected to depreciate by 0.8 in the following months. So what is your suggestion to FBI? Okay, just imagine you are the senior manager of finance. Okay, so what is your suggestion to FBI in order for the company to maximize their earning in Malaysia ringgit if the opportunity cost is 8.5%? So just calculate if FBI hold the letter of credit until maturity. So the face value 5 million minus acceptance fees, which is 2% per annum. So we just divide it by 2, or another way is 0.02 times 6 over 12 also can, right? So after you minus, you will get 4,950,000 US dollar. Okay, if the letter of credit we hold until maturity. If we sell today, so the face value minus the acceptance fees, 2% per annum, 5 million times 0.02 divided by 2, 50%, 50,000, commission fee 0.5 of face value, so times 5 million, 25,000, discount rate 7.5 per annum, you will get 187,500 and the amount of receipt is 473,700. Okay, and then so for this question, the question is maximize their earning in Malaysia ringgit, but the value is USD. You have to exchange you have to convert USD to Malaysian ringgit. Okay, so if the letter of credit, we hold the letter of credit until maturity, this is the value after 6 months. So we have to find the forward rate. Forward rate here, Malaysia is expected to depreciate 0.8 in the following months. So you have to remember how to find the forward rate by using percentage. So 3.6290 times 1.008 because depreciate, meaning that the value is bigger. Okay, so after 6 months, the Malaysian ringgit is going to be 3.6580 from 3.6290. So this indicate that this value, okay, 3.65 is bigger than the spot rate. This is depreciate, okay. Malaysian ringgit is expected to depreciate. Okay, so we have to convert this value. Sell USD for Malaysian ringgit, you have to find, you just convert. Malaysian ringgit will get, in Malaysian ringgit, 15,107,100. And this value is after 6 months. We cannot compare with this value because this is today. Remember, this is different time. So we have to find the present value. You just minus with 1 plus 0.085. This is the opportunity cost, this one. Divided by 2 because 6 months. So the present value is 17,368,920.85 in Malaysian ringgit. And we cannot compare with the letter of credit at once because different currency. So you have to convert this currency into Malaysia ringgit. This is today. So we have to use we just take the spot rate. Okay. So sell at spot rate, you will get 17,192,387.50. So the company should hold the bill until maturity. Why we choose until maturity? Because the value is higher compared to once. Whatever it is you have as a seller, we tend to we tend to choose the value which is higher. It can be this option or can be seller sell at once. Okay, tidak semestinya you have to choose until maturity. If the value for seller sell the letter at once is bigger than whole until maturity, so you just choose this one. Whatever it is, you have to choose the biggest value. Okay, so I think that's all for this this topic. So yeah, I really hope that this video will make you more understand and can answer your final exam successfully. Okay, all the best everyone. Thank you. Assalamualaikum.